All right. So I think we're going to go ahead and start. Again, good morning, everyone. Thank you so very much for tuning in into this training. This is the only way we're going to grow, right? This is the only way we are going to master our craft. We want to be independent. We want to know what's going on. So when we are, you know, writing a policy, we know exactly how to illustrate, right? And how to explain it to a client so that they understand the value of this product. So everybody here knows me. We don't have anybody new. It's Patricia in the house this morning. I hope I'm gonna be making some valid sense here this morning, right? You guys trust me? Do you trust that I'm gonna be a good trainer?
Sure.
Yes.
All right. Well, thank you guys. Thank you. So let me share my screen. Okay. Go ahead and do that. I got too many things open here. There we go. All right. So here is where you are going to be opening. I'm sure everybody here has already set up their F&G account, I'm assuming, right? So if you haven't, maybe after the course, or you can follow up with whoever your upline is, if you need my help or whoever, to set you up. But usually you have to contract first. And once, they approve you, then this is where it's going to take you, right? When you create an account, you'll have to be able to log in. So here, as a financial and insurance professional, this is the first tab here that you're going to click. But if you're a client, even if you're an agent, if you're a client where you have a policy with F&G, this is where you will have to create an account and come as a policy holder if you want to see how your account is performing, okay? So for today's training, we're going to focus on this, the financial and insurance professional. So you go there, you're going to use your credentials to log in. And this is where it's going to take you. This page is going to open and it's going to look exactly like this. Okay. So if you have your laptop, you can also mimic and just, follow the steps as I'm training so that you're also kind of like, making sure that you can log in and you can do exactly what I'm doing here. So just practice pretty much. So how do we go to illustrations? So here on the top, you can see, right, there are different tabs. One, it will say my business, right? And when you click on here like this, it's going to drop down all these things here. It's going to talk about the 1099 tax statement, book of business, commissions, new business. So, I encourage everyone, as you're learning how to navigate on this front, back office or whatever, just click every time, just click on one tab and just self-teach yourself. Sometimes you find a lot of interesting things here. Just because I'm training you doesn't mean that I know all these things, right? I also learned from you guys. That's just like yesterday, we had one of our partners that said, oh my God, I have something exciting to show you guys. We look at this thing every day, but we don't really click on it, right? And then you find something that is really amazing. So on my agents, also, click on there. It has some stuff there that you can just, click on it and see what is in there and just kind of like self-teach yourself some stuff, right? And maybe you can share it with us. Products, sales tools, forms and materials, training, availability, rates, and communications. So for today, we're going to click on here, right? Which is the sales tools, and we're going to go ahead and click on illustrations. Also, I want to mention that the same tabs on the top appears on the bottom. So it doesn't really matter which one you use. You can go on the top, you can go on the bottom here as well, where it says sales and tools, illustrations, right? You see that? So let's just go there. When you click on that one, this page is going to open up, okay? So there's going to be two softwares here, right? The first one is F&G Annuity Illustration, and the second one is F&G Live Illustration. So depending on what business you're writing, you have to be very careful. Be specific. If it's annuity, you're only going to click on the annuity. You can't mix the two. You can't mix the two. It's not the same thing. It's different. One is annuity and one is life insurance. Because I know sometimes it can be like you're busy and you're not paying attention. You know, you're new, maybe you're doing it for the first time, and then you just say, oh, well, I'm just going to click on here. And meanwhile, you're trying to, write a policy for life and not annuity. So here, for today's training purposes, we're going to click on Explore Illustrations, right? On the paper guide. So once you click on there, this page is going to open. There's going to be two tabs. Start a new case, and the other one will be View My Cases. So View My Cases would be in an instance where you've already, written, this illustration, you designed it, and you just want to go there maybe to check the premium or whatever it is that you want to do would be on the View My Cases. Everything that you have written, if you've saved that illustration, it's going to be under viewing, your cases. But for today, because we're just training on a new case, we're going to click on starting a new case, which is this tab right here. All right. So once you open this case information, now we're going to fill in the information for the client, right? So in this case, I'm just going to make up a client, Jane. Okay, we're going to do Jane. Sorry, let me go ahead. Name this client as Jane Brown. Okay. All right. Then we'll come to the age. Here, we're going to put the age. Okay. And we make that Jane Brown is a female, 32-year-old. And then come here where it says a career and product. Very important. On this one, it's not really necessary. You can put as an example, just as it shows here, if it's a kids policy or an adult policy, but really it's not really necessary. You can just add on, the first amount for the client, on the application. I think on the next page or something like that. But here, this is all I think we're gonna do is to select which state the client is at. So I'm in North Carolina. So if Jane lives in Georgia, I'm going to choose Georgia. If Jane is in Maryland, I'm going to put Maryland in here. So let's just assume that's where our client is. Okay. And of course, it's going to be the Index Universal Life. And then we're going to find the available products here. They're going to be about 4 different ones, right? So the specific one that we're going to be concentrating on, this product is the FG Path Setter, select that. Very, very important to select the correct product. So when you come here, this page is going to open now, right? And it will have the client information. Make sure that it's correct. If you have made a mistake, maybe on the gender, which I have, before when I was just starting, I made that mistake without even realizing. So it's always good to double check yourself that, it's a female and not male, right? Or it's a male and not female, vice versa. And also make sure that the age is correct as well, the birth date. Just, make sure you go through that, or you ask the client, just double check with me here. Is this the correct, date of birth and stuff like that. Okay. So here we are not going to change anything for the underwriting class. We're going to just leave it as standard, right? So after the underwriter goes through the application and everything, depending on what they find medically or weight-wise or whatever it is, the underwriter is going to make that determination to change what class here is going to be like. But for right now, we don't change anything. We just leave it as it is. And when it comes to And this underwriting guidelines is also something that if you wanted to find out exactly, what the guidelines are before you even get into there, like the contents will show you exactly here. The blood pressure limits, like, if the client has, blood pressure, what are the limits that they would accept, right? And if you wanted to do a cover letter for a client, you would find it here. You can look and see the weight as well. If you want to see if the patient, how the client, see the client, the weight and everything like that. So this is very, very good to know, because sometimes if you're not sure, I don't want you to guess, and put something that can actually put a client in a criteria of being denied, right? Or when you go here and you're not sure about something about cholesterol, if the client tells you that, they have cholesterol and everything, just go there and find out the weight is going to be there. So very, very important to have that. Okay. So I just thought I would mention that. So on the solves over here, we do not do anything, right? We don't do anything. We leave it as it is. And then we come here where it says face amount. And then we put now the face amount for the client. So because we're training, right? We always train on 1 million. So we're just going to put 1 million there. Okay. So that's 1 million. And then the death benefit option. All right. There are options. When you click here on this little tab, it's going to open 3 different options, right? Option A, option B, and then, varies option B to A. And A is usually level and B is increasing. So for what we are doing here today, it's always, 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 option B, depending on the client as well, right? On the age of the client and how they want this to be set up. So that, depends on each client is unique. So, but usually for the most part, you're going to be using increasing, which is option B. You don't do anything else here. You come here where it says premium, mode. So depending, the client might say, okay, I'm going to pay maybe monthly, but, for your own self knowledge, when you click on there, it will give you different options of how the premiums can be paid. So it can be semi-annual, it can be annual, it can be quarterly or monthly. So but for today, we're going to go on monthly. And then here where it says premium type, always click down there and see what it is, right? It's always target, specified level, specified varied, and minimum. So it depends on how you're designing this illustration. You can use these different tabs, but for our training purposes, we're going to go on target. We're going to leave it on target. Okay. And the pay premium is up to year 100, right? And the first minimum premiums to 15. We don't do anything here. But when we come to allocations, interest and credit options, these are the allocations. We already have by default 2 of them that have been selected for us, which is the Morgan Stanley 50%, right? And also the BlackRock, which is 50%. But if you want, to be aggressive with your cash accumulation, right? We're gonna diversify, meaning it has to equal to 100. So with these 3 down here, okay, we're gonna do the first one at 33%, and then the second one would be a 34%, and the third one be another 33, which gives us 100%. Right? You can leave it as 50-50 there. It's still okay, still perform okay. But if you wanted to do even a little bit more better, where you diversify it, you're going to break it down, in this formula here. So if you're not very, sometimes people might forget if you're writing a policy and you'll be like, oh my God, what are the allocations again? So you can get a snapshot of that, right? So that when you're writing a policy, you make sure that you are choosing the right allocations. So this will be it. And then when you go down here, you don't change anything. Everything is already here by default. We're not going to change anything. So those are the only plugins that you put in, that information that we just filled in together. Okay. So after this one now, we're going to go to calculate. Okay, calculate results. So we see how this illustration is going to look like for the 32-year-old. Okay, so first of all, I'm going to go to the premium summary before I come on here. All right, it's always good to come on here so that you can show the client what the premium and what the payments are going to look like. So the description here, okay, which is the amount, is going to be $7,480 annually, okay? 12 months, this is how much the client will have contributed, which is the same as the target, right? And then the Molder premium, meaning the monthly payment, is going to be $623.33. Very, very important for people, for the client to know. And this is where now you can ask the client, do you think that this is comfortable for you? Because apparently before you even go here, you'll have done a needs analysis, right? So that you ask the client, like, how much is, the household income, and what are their bills and all that kind of stuff, and how much can they put aside for their policy, right? That they can pay every month comfortably without them saying, oh my God, I'm short, or, because we don't want this policy to lapse. So make sure that the client is getting exactly what they can afford, right? So at this point, Miss Jane says, I'm totally fine with 623. I can afford to pay that. So, and also we're going to go down here to the minimum, premiums, which is a minimum no lapse pay, which is a 3,740. Also, I would like to mention the 7 pay, because usually this is also another great value to mention to the client. The 7 pay, meaning the premium, meaning, the maximized amount that IRS allows you to put in this account. That's what the 7 pay means, because sometimes people mistake it and think like 7 pay meaning paying for 7 years. It's just a term called 7 pay premium. What it means is that the IRS has allowed Jane Brown to put, to invest $54,000 in a course of 1 year, right? $54,450.14. They cannot go over this amount, right? So do I have any questions on this one? No questions. Okay. So
Yes. You didn't explain can we go back to the summary? Yeah, you didn't explain the guideline single premium and the guideline level premium.
okay. So here, this is the minimum that you can pay, minimum, and then the guideline single premium, 175. I think this is the amount that you can pay in the course of 7 years, if I'm not mistaken, right? Gigi, can you agree with me?
Yes.
Yeah, you cannot go over that amount in 7 years.
Okay.
Yeah.
Exactly. And then the guideline level premium would be 34,434.83. So when we come to the policy summary now, right, this is how it's going to look like. So you're going to tell the client, in year 1, at the age of 33, this is how much you have contributed. And then this loan and withdrawal, this is where now if you want to withdraw any money or get a loan, is going to fall under, right? It's under this column. The account value is a value that you have for the first year that you have in your account. So you've accumulated 7,880. What's going on with my numbers today? 7,480,000, right? This is the value. The surrender value is where that cash accumulation is going to be happening. It's going to be under this column, right? That interest that you're going to be earning is going to happen really in this column. The first year, you won't get anything. Jen won't get anything this year. But when we move to the death benefit, remember it was 1 million, right? So always the value, the account value is always added to the death benefit, which gives us now not just 1 million, but over 1 million, 4,666, right? So when we look at the fifth year, this is how much the annual, this amount, actually, let me go back. Okay, so this policy actually is going to run for 120 years without lapsing. And the premium doesn't change. It doesn't matter after 2 years, after 10 years, after 20 years, it doesn't change. It remains the same. So meaning 7,480 every year will run all the way until the age of what? There we go. Okay, this one right here, the age of 120. How about that? Right? So at the age of 120, I don't know who's going to be living at the age of 120, but look at how much the value is for that client's account, and look at how much money they have in there, 23 million, 24 million in death benefit. Okay? So let's go back here. So I just want to make sure that premiums don't change and the policy will run up to the age of 120. So if we look at year number 5, okay, same amount there that you're contributing. Now the cash value has changed. Remember, in the beginning, the first year was 4,666. Now in the fifth year, you have 26,738. How much can you take out of that account if you needed to get as a withdrawal or as a loan? The option is yours, right? Now you have 20,754. And the death benefit is going up. This is what we call the accelerated death benefit, that the death benefit accumulates. It goes with the value of the policy every year, right? So now let's move on to year 15. This is amazing. Same amount of money you're contributing. You've contributed now. Look at the value of that policy, 126, and that 126 is how much you can take out of that account. And also look at the death benefit, right? Imagine you put in 126 and you can take out exactly the whole amount, withdraw the whole amount that you have put in here, right? And still your money is compounding over the years. So this is a great benefit called what? Compound interest. You see that? So also, let's move to the year 65. If we go to year 65, look at how much money you've put in there. That's the value. Look how much money you can take out of this account, right? 662. How many people retire with 662 in our community? A lot of people don't. We are retiring with maybe 200,000, and you've been working for 30 years, 20-something years, depending on when you started working, right? But at the end of those working years, you're retiring, most of us don't even have 300,000. And if you had even that 300,000, guess what? You're going to have to pay a whole lot of taxation, right? But here, this is a tax-free account. So that is what we call a benefit, what? Tax-free death benefit, meaning you are not paying any taxation. And guess what? Look, this is how much money you can get that you have grown into this account. That's that power of that compound interest, right? So remember when we're doing the presentation, like the one we had yesterday, we talked about court probate. Majority of us were in that meeting yesterday, right? And we talked about court probate. So here, I also want to demonstrate that when you get to the age of 74, let's just say, okay, I'm going to go to the age of 74. Look at that. Actually, I should mention that. Year 71, you already are a millionaire. How many people in our community are 71 years old and they have 1 million? They don't. That's why we're educating our people to say, set yourself up for an account like this and save your future, right? Create that generational wealth and have a tax-free retirement that you're going to enjoy without going back to work. So we talked about probate court. That's another great benefit that I would like to, demonstrate here. So supposing something happens to me at the age, or Jane, we're going to give Jane, because this is Jane's account. So Jane is now 74 years old. Something happens to Jane and she's not here anymore. How much money is it that she had in that, that she accumulated? 1.2 million. So the death benefit is now not 1 million, guys. Look at that. It's now doubled. It's now 2.2 million. So if Jane had to pass on, guess what? The beneficiary will get all that money, right? Always the value and, plus the death benefit, which equals to what? 2.2 million is going to be given to the beneficiary, probate court free, meaning probate has nothing to do with this money. This is your private account. This is not the government. You set yourself up for this great account. So therefore, something happens to Jane, Jane leaves this money to the children, to the spouse, to the family, tax-free. Okay. And we also, have to realize that we talked about the sicknesses, remember? So in case of any terminal illness at 74, I'm diagnosed, maybe, Jane is diagnosed with Parkinson, all right? Or early signs of dementia or whatever it is. This is also another great benefit, the terminal illness income rider, which you get when you get this policy. The living benefits that we emphasize, this is where now it comes in. So if Jane was diagnosed also with a terminal illness, meaning the doctor has given that prognosis, that you're going to live at least for 12 months and less, 11 months, 10 months to live, 6 months to live, guess what? You will be given that 1 million, 100%, 1 million from what? From your death benefit, from that death benefit, and you're going to use that money while you are still living. See, this is not the insurance that majority of us know, where it's just death, when you die, like a terminal illness, and that's it. I mean, death benefit, like from work, that's a great example, because a lot of people say, oh, I have insurance from work. But really, it's not going to be there for you in terms like this. The living benefits always comes in play when now things start declining because of age. And also, with terminal illness, nobody knows what tomorrow will bring. If you're diagnosed with an illness like that, what happens then? You are well prepared because you had this policy. So that's another one, right? So the critical illness, of course, depending on the severity of the illness, they'll give you at least up to, maybe 90, up to F&G actually gives 100%. So also depending, is it stage 1 cancer, stage 2 cancer? It will be different from stage 4. So, they'll just calculate there and see how much they can give you. Is it 80%? Is it 90%? Or, or is it 100%? But guess what? At that time, you're not going to be worried about how, you're going to be taken care of, how you're going to pay for, for your treatment and stuff like that. You are not depending on the government. You plan well and you have this money to take care of you. So that's when, we demonstrate and we talk about those things, the critical illness, the terminal illness, and the chronic illness, right? So access to cash, just like I said, is another great benefit, okay? This column here comes in. How are you going to get this money is up to you. But our recommendation is don't draw this money, because you don't want to, take the whole 715. Then how is your money going to, you're going to affect this compounding factor here. So you have a privilege to get a loan. And this is why they say you use this account as your own bank, right? Get a loan from yourself. And then this money is still going to grow. Imagine you take a loan of 600,000 or 600,000 and buy a condo, 2 condos, and put them, on rent and stuff like that. Guess what? The next 5 years, look, your money is still growing. 77, right? You have $1 million in 5 years. But if you had to take the money out as a withdrawal, then of course you're not going to have this one. But why would you want to do yourself like that? Right? So, in that money, they said, how do you pay that money back? The decision is yours. You can pay it back to yourself where, you're only paying a very minimal interest rate other than, you are paying, taxation. There's no taxation. You're only paying back yourself with a fraction of our interest rate. Well, if you decide, I don't want to pay this money back, that's okay. You don't have to pay it back. But guess what's going to happen? What's going to happen is that something happens to Jane, and she passes away because she took some money out there. She took 600,000 out of that account, and now she passes at the age of 75. Guess what they're going to do? They're going to take some money out. That 700 or 600,000 that she got will be deducted from the death benefit. And then whatever is left is what is given to the beneficiary. Okay, so I'm going to pause there before I go further. Does anybody have a question with what I've just explained?
I have a question, Patricia.
Yes.
If I would like with that the same policy contribute until age 62 and receive an income at 63, can you design that same policy with those two features?
Okay, so let me go here. So you said that you want this policy to stop at the age of 62?
Yes.
Contributing at 62, right?
Right.
Okay. All right. So you're contributing at 62, you want to stop so that you can start taking your money out, right?
Sure.
Okay. All right. Okay. So hold on 1 minute. Okay, you said that's 62. What's going on here? You should have, okay, there we go, 62. All right, so at 62, this person had how much? 4 million. So
Patricia,
yes.
can you go back and do A62 instead of Y62?
Hold on a minute. Yeah. Oh, age, sorry.
Yeah.
All right, that makes sense. All right, so let's go to age 62. So there we go. So you've contributed all these years, and then now you have 523,440. What I want to say is that you're not putting any dime, right? You're not paying any more from age 63. And I want you to see that this is going to run all the way to 120, right? So imagine you put in at the age of 62 when you stopped contributing here. Did I go past it? Yeah, right here. You've only put in 523. This is how much you've contributed. That's a value, right? That you have 523. You're not putting any money at the age of 70, at the age of 80. you already have 1.6 million, and this is how much money you have access, where you can say, you can set it up where you can say, well, I want to be getting maybe 30,000 every month from my cash accumulation. Does that answer your question, Noka? You are muted.
Yes.
Okay.
Thank you.
Okay. All right. So anybody else has a question?
I can add something.
Mm-hmm.
Okay, another way of looking, of course, this person is putting in 7,000, right? So at age 62, you want to think about how much do you want to take out? How much are you trying to receive as income? If you want to receive a big income, all these years you contribute a lot of money. Like you can put like a more extra every month, right? Same as, when you're trying to pay off the mortgage, you add more on your principal. So, but now you see, if you have a 500,000 at age 63, 500,000, are you trying to take out 50,000 every year, or trying to take out 10,000 every year? So the best way to see it, how much you can take out and your policy keeps growing. Patricia, if you can just go back a little bit, you can scroll, cancel that.
Cancel this?
Yeah. And on solve, go on solve, put income, solve as income.
Income stream?
No, income, just income. At the bottom, there is income. Is it income stream or maybe income stream? Yeah.
Income stream, target first income.
Income stream, yeah. Okay,
All right.
now change to from, no, that if it as this, go down there, start age, do 63, like she said. And then,
Yes,
so
for how many years?
25 years, do 15 years, for example, do 15 years. But this 25 years is with the big policy. I'm going to also show you for the 25 years how it will look like, but do 15 for now, right? And then click OK and run.
Okay. So now, there we are.
All right. So you see,
Go
you
ahead.
can, yeah, you can withdraw 42,000 net income, not gross income, right? Net income, which is, for those who work at the job, net is different with gross. You make 50 or 60,000, but you don't take home 40,000. So, but this person taking 42,000 from age, actually, we should probably take but that's fine. It makes sense. 42,000 every year for the next, scroll down, let's see.
We'll
You
put it
see,
for 15 years. You
yeah,
still,
even if we did a 25, it could still
it
growing
could still grow, yes.
all
Because
the
you
way
still
down.
have money.
Let's see where it can go. This policy will go all the way to 120
Exactly.
and keeps growing and give you income for the 15 years. Even you can even leave at the 25 years.
Exactly. You still have money. That's the autopilot. So let me go back. I can even just for the heck of it. Okay, we did here.
Go to details, click on details. And then leave 25.
Okay. So you can see, look, so now it even actually now calculates to 33 instead of 40 because now they're paying you for more years, you know, not 15, but 25 years. So you get that 25 years, 33,000 every year, okay? At that time, you still have 532,000 left into that account. Imagine that. Meaning you can even get a little bit more than just, you know, 30,000 or 40,000 on that. You still have a lot of money that, you know, can be left the beneficiary or the money that can be used for long term for you, you know, if you had any kind of like, you know, any need for a nurse or anything like that. Yeah, you still have, and that, you know, it still goes on all the way up to age of what? 88, 120. Look at that. And can still leave your beneficiary and your great grandchildren 1 million. But look how much money you put in. Not much. Not much money that you contributed, right? Only 500, 523,000, and has kept you going all the way with quality of life, all the way up until in your 80s, and still, have money. If you go all the way up to, age, let's just even say 100, or 110, still have 100,000 to take care of you, and money still from your death benefit that you can actually use as collateral if you had to, finish or, finish using this money or whatever. You still have that money that you can use, as a collateral for yourself while, instead of giving a burden to your great grandchildren or your children and everything like that. That's the way I look at it, because, you have to prepare for all these things, right? You have to prepare for your old age and all that kind of stuff. So 500,000 has really done tremendously well, for this client over here. Who wouldn't want to have this kind of a client? So that's the flexible income we talked about. Okay, we're going to talk about that. So anyway, anybody else has a question on this one? This is an amazing account, guys. Amazing, amazing, amazing. Everybody has to have this account. I wish I knew about this account years and years ago, but I'm glad that we have it now moving forward, right? Any other question?
Okay.
So,
Yeah, I can also add another scenario here. Guys, the purpose of this illustration is for you to get familiar with showing the clients the best and what they can do with their money, right? So let's say if you were to get out of this, go ahead and let's say you get out of this, and this client is contributing. How much was he contributing monthly?
was 300 and something dollars.
Okay.
Oh, no, 600 and something, yeah.
So now, what if the premium was 1,000, right? Because some people are planning to add more money as they go. What if it was 1,200 every month, right? And then
You want to change everything else to a year?
no,
Maybe
I just changed the premium, because even some agents here, they say, once I start making money, in the 5 years, I'm gonna put in money in my account. So you want to see, you put in 14,000 every year. You're funding your account 14,000, right? You gotta look at this. This is something even for yourself, you have to put in your mind, right? Because when you look at average household, they are paying at least 2,500 to 3,000 in a mortgage or rent. When you do multiply by 12,
you end up paying 30,000 on mortgage, right?
Mm-hmm.
Or let's say even if it's 20,000 on a mortgage, and they think that that is an asset they are contributing. That mortgage at age 62, it would be worth, let's say, the house is 800,000. It's not really 800,000 you made, you know. So without that concept, I want to just show the same concept. Someone want to put 30,000. I mean, it's no choice, by the way, on a mortgage. You gotta pay rent. But if you were to contribute, or you tell your client, if you were to fund your policy to the not even the maximum, not most people don't have that 7 pay premium where they can put 54. But if they can manage to put 1,000 or 1,200 every year, this is what's going to happen. They will have an account at age 62. You stop, but it start paying you 123 a year. Look at that.
Mm-hmm.
Hmm?
Better than a 33,000.
Look at that. And this is the money that is coming to your, like, as a net. So if you want to make 6-figure in your retirement, start now. Fund your account, because now you don't have to work. Who can work if they are receiving 123,000?
Nobody.
And you know, and then when you can see you still have some money when you get up here on your cash surrender, and then you stop withdrawing the money, and then it goes back up. It goes back up.
Mm-hmm.
So this is how people use these accounts. But if you are paying minimum, you will get minimum as well. So
Exactly.
those are the things we put in mind, and also we teach our clients to fund to make these as their great retirement accounts. Okay, that was it.
Mm-hmm.
Can go back to normal.
Oh, yeah, okay. Let's just zero out everything and
Yeah, I saw someone had a question.
okay. If you have a question, you can ask.
Justina.
You can.
Yes, good morning.
Good morning, Justina.
Yeah, my question is about pretty much a minor, because you know how if a parent doesn't have a policy, the minimum you can give is 200K.
Mm-hmm.
So what is sometimes, like, I know you can max fund. Is there a way that you can design the policy that the parents can contribute more into the policy, like the premium?
Yeah, of course. Even if
Like,
it's
for instance,
small,
if the parents say I can afford like 200,000, is there a way that you can
if
Can
the
I ask
parent
you?
says they can contribute
$200?
$200.
No, so $200, sorry.
Uh-huh.
Can I answer that question?
Yes.
So there are two things here we want to clear on to answer the question, Justina. Why is the parent doesn't have a policy and want to put so much money to the child's policy? Is it because they were denied, or they don't want to pay higher premium on their life?
Well, the parent has a policy, but with another carrier.
Okay.
So
Which is how much?
she had over like a $500,000, but it's not with FNG.
Okay, right there. Let me just answer right there. The rule is not you have to have a policy with FNG. You have
Oh,
to have a life insurance policy, period. It doesn't matter which company. And it doesn't matter if it's a term. It doesn't matter if it's a whole life or IUL. It's a life insurance policy, excluding group life, right? Because group life are not individual. So, I mean, those at work, but any term life or whole life or IUL with any company, If it's a $500,000, so the rule doesn't apply to 200 anymore. It can be 250, right? A half of what the parent has. Okay. So yeah, just I wanted to clear that before I go further. It's with any company, not FNG. Okay. Does it make sense now?
Yes.
Okay.
Thank you.
Yeah, because I wanted to clear that first before we go to the premium side. But now you got your answer, right?
Yeah, I got the answer. I was having a misconception that it has to be an FNG. But now that I know better now, so I can give a better education.
That's right.
Mhm.
Okay. Thank you.
Okay. So also, I wanted also to demonstrate that, sometimes somebody can say, well, I don't want to pay, this for a very long time. So I want to pay it, just for up until I'm 50, yeah? So it's going to be year 50.
Age.
So age,
Yeah.
so I can do 10. Okay, so somebody says they want to pay only for like 15 years. That's what I'm saying.
Oh, that would be why 15.
Yeah. So somebody wants to just pay for 15 years. And then they want to stop.
Yearly.
Hold on. All right. So
Per year, right?
yeah, yearly, yearly.
Okay. Payment mode.
Target. Annually. Okay. So let's calculate that.
Go back down. It looks like it disappeared.
Oh,
Go
really?
back to Y15 and do Y15. It went back to
Oh,
age.
it went back.
Mhm.
Okay.
Y15.
It changed to age. I thought it was just the
Yeah.
number. Okay, Y15. All right. So for 15 years, I don't want to pay up until I'm 120. What's going to happen? I just want to show you here. Okay. So this person have been paying that 7,777 all the way up to year 15. And now they have 127. They're not putting any money in this account. Is it going to stop at any time? Let's check that out. Okay. So at the age of 60, we didn't change this.
Yeah, the income stream is still in there.
Yeah. Well, what I'm saying is this policy will go all the way up to age 100, but we have 120. We have to change that. I wanted to demonstrate exactly that. So 1 million annual payment, 10 to 15. So where did we go wrong?
Run.
You go
Solve with.
Why was it showing after 15?
Yeah,
because of the income stream.
Yeah, it's still on income stream. Go to none. Go to solve at the top.
Oh, okay. It's still on there. We didn't change it. We didn't change it.
And then go to
details.
No, you can go to none. Solve to none. X this out. X this out. And then solve none. Solve for none. Yep.
Okay, so that wasn't, I was wondering, I was tripping. Okay, let's see. All right, so 15 years, this person has been paying, no more paying money in that account. As you can see, how much have they contributed? 127, okay? And they can take up to 126, and that's their death benefit, right? In 15 years, 127, and this account can still run all the way. The money is growing. Look at the time. You've only put in 127. Remember, guys, you put in 127. Now, at the age of 65, how much money do you have? Is it year 66 or age? Let me see here. Middle is the age. Okay. So at age 75, you have 721,000. Look at that. And you've only put in 127 and you're not putting in any more money, but your money is compounding. To me, that's amazing. 127 has given you now 721. You haven't been putting any money in that account. Even at the age of 67, when you're retiring, you've only contributed 127, but look how much money has grown into that account. You see the compound interest, guys? 454. That's a lot of money, considering you have not been contributing anything for a number of years and you have that money in your retirement, right? I had a hand, Monique. You're muted.
So talking about those 15 years, I have a question. Is there any limitation? Can I pay up to 15 years? Is it kind of like any limitation? Like, can someone say, I want to pay like 5 years or 15 years or 20 years? Because I know also if you don't pay the policy, it may collapse. So is there any limitation to the number of the year you can decide to pay to?
Well,
If it makes
I
sense.
don't think there's any limitation. It's up to you on how you want to fund the policy, how long you want to fund the policy, and when you want to liquidate your premium.
So let me ask it
if-
again. Let's say for this policy,
Mhm.
we know the yearly payment is 7K.
Right.
And can I just say I'm just going to pay 7K for 3 years and stop?
Yeah. Well, it's not going to run for a long time because that's very little money.
Exactly. So that's why I'm thinking about it. Is there any number of year? Because I saw something in this, like here, first minimum premium to year, and they said 15. Does it mean, is it like that's, I don't know how to ask this question, but what does it mean that's 15 here actually?
Well, my understanding, well, DS is here, but let me explain. So the first minimum premiums to year 15, meaning if you pay less than what you're supposed to pay, with the guidelines for that policy, obviously it's not going to perform very well. It has to be at least 15, maybe 15 and up. I might be wrong because the way you're explaining, Monique, right? So you're paying 7,000 and you pay for 3 years. Already, you already know it's gonna be like 21,000. It's not gonna run too far. So it's how much you put in there that will determine how you're going to. Okay, so here's the thing. Let's just run those numbers, right?
Mm-hmm.
Yeah, we're gonna change it here to. You said 3 years.
Mm-hmm.
Look at that. You've only put in 15,000. Okay? 15,000. I don't know why it's doing that. So we have to go back again to change something. Okay. This is solving for none. Okay. And it's an annual target, 3 years, 15. It's correct. So let's see. So it's only 3 years that you've paid, which gives you only 21,000, right? I mean, 50,000. So this 15,000, the surrender value is what? 8,000. I mean, the surrender value is 8,000. How long is this gonna last, right? So you only pay for 3 years. Dear Jane, why is this still showing this amount here for 15 years? How can I zero that out? Because it's still demonstrating. Go ahead, Gigi.
Okay, I was gonna say it's based on, you see where it says, scroll down, where it says first minimum premiums to year 15. Yeah, that's why now it came back, and then you put it up to 3 years, and then after that it calculates because you are forcing the minimums to go for 15 years. And the reason why this is it here, let me share my slideshow of what Just 1 second to explain, but don't get away. Don't leave that. I wanted to explain why the 15 years, because it's based on the single guideline, single premium. That with the DEFRA, there's the TEFRA, DEFRA, and those three
Yeah.
acronyms. The DEFRA is an acronym for the Deficit Reduction Act of 1984. This act introduced the 15-year rule with the intent to further discourage the use of life insurance as an investment vehicle.
Mm-hmm.
So that is why that 15 years is it can only allow you to put in a certain amount so that it doesn't change and become an investment, and it's based on that DEFRA. I don't know if that makes sense.
But based on this question, like the way she was asking, that you pay 3 years for 7,000, that's not a whole lot of money for it to carry you. I mean, you cannot put anything in that account. It will still go on. You can see it will go on. It will go on up to the age of, it looks like it stops from.
Can I chime in?
Yeah. From the age of 76, you didn't put in so much money, so it's not going to do so much. Yeah, go ahead, Deirdre.
Yeah, so what it is, like what Gigi explained, that is the correct. So you only chose to put annual premium for 3 years. So normally it would, for the next 3 years, you don't have to contribute anything. But they tell you, in order to protect your policy to lapse, at least you need to start putting at least the minimum, which is a half of what? A half
7,000.
So at least put in minimum for the next, 8 years, whatever, so the policy can carry out at least until age 75. That's when it's going to lapse, because you really didn't put much. And what you're putting in, it's getting it up into the cost of insurance. So that's why the illustration, guys, you have to understand, illustration is not application. This is not a client's policy. You are showing the numbers and the performance of how the policy can go. So it means that you never even ever run this thing for your clients. If you want to run showing 3 years, you go with maxi funding your policy.
Right.
So that is, and then to answer the question of, is there any minimum years you can run? So forget about this. Don't be confused of forced minimum. This is just like what Gigi said. This is the default. So at least you gotta make sure like you have 15 years of minimum payments to protect the lapse of your policy.
Exactly.
But decide to stop at any time during the early years, because you have to know that after 15 years, the policy has matured, the cash value has grown, the compound interest is high, and the high chance, of if you funded in the first 15 years, you funded your account properly, it never lapses. That is the thing, it never lapses. So if you ever want to do this, you gotta come here and you specify amount. You choose, you say this client want to put 50,000 for 3 years and then be done with it. If you run like that, then it guarantees that it can run as a SOFA, right? So that would be a different scenario where you only put 150,000 for 3 years, and then your policy, you can see that your policy can run all the way to 120. Why? Because you funded almost, more than if you were to put 7,000 for the next 15 years, you already funded that amount in 3 years, right? So that's now how the power of compound interest is going to kick in and just be in your favor. So there isn't any, but if you were to only do 1 year, or 50,000, it can also run so far, right? You have to keep that in mind. I don't know if that clears your question, Monique.
Yeah, that clears the question, and I learned a lot. But my question wasn't for the clients, but it was for me to understand how the thing's gonna be working. But I'm not gonna be showing them this to say, oh, you can pay up to 3 years. No, that's not my goal. But I want to myself understand how to run this thing.
Yeah, absolutely. Because you gotta understand, you are a client as well, because you're gonna be funding these policies. So it's good for sure to know, even on your behalf and yourself. Yeah, that's great. Yeah, but yes, these 3 years is good, right? For people who have money, max fund your account. Look,
because this is what I wanted to also say is that, say for instance, right, there are people who have money. We had one of the clients that said, I have money and I want to do 7 pay, for the next 6 years. So in this instance, dear Jean, you can go to the 7 pay for the, how much was the 7 pay here? 54,000?
54,000.
Yeah. You can do that. The person said, I want to pay that for 6 years. For 7 years, she said, I want to pay this because we multiplied it. I think it was 6. Just do 6 years. 6
they
years.
won't allow us to put 54.
Yeah, but they broke it down. They broke it down. But she had that kind of money. She says, I would rather put the money in here.
Okay. Once it hits the guidelines minimum.
It's gonna, recalculate, which is fine.
What happened? Say 6.
Right.
And then was it 54?
Yes, 54,450.
Nice.
And Tuku's got the numbers down correctly.
Tuku is on.
Okay. Yeah. Okay. Yeah.
First 4 years, and then the rest is
Yes.
gonna.
So yeah, so you see how it really calculated. So at the end of that, how much money have they put in? 225, right? So they're not gonna put any more money in this account, but look how it's gonna run. Look at that. Right? So by the time they're 60, they already have over $1 million. $1 million. And they have not put anything else but how much?
It's even less than
Exactly.
even less than
225. So this account, you can just, the most important thing, to be honest with you, for the numbers to make sense and to create that wealth that you're trying to create here, you have to maxi fund your accounts. You might not have the money to pay the 7 pay, but even just, you saw when Dios plugged in the 1,000, how much difference that could make. A big difference. So every time you have a little money, extra tax refund, bonuses, overtime, cash, whatever it is, put it in this account all the time. Just put it. It doesn't matter. At the end of the year, even if you put like 6,000 more, 10,000 more, 5,000 more, it's gonna perform way better than you just paying the monthly payments. So the last thing I wanted to demonstrate was the $1 million baby.
Okay. Oh, I was going to. I
Okay,
know
you want to do something else before we go to $1 million baby? Because that's the last one. I'm looking at the time because it's 12:50, 12:14.
This won't take a minute. I wanted just to.
Okay.
If you were to do this, and then start receiving income.
Okay.
See, now you have created another 6-figure in your retirement for the next 25 years. Taking a loan from your policy, right? Just for only 200 something thousand.
Yeah, 225.
Go ahead.
Yeah. Let's just zero out everything.
Yeah.
So we're gonna change the date of birth here.
We've done many things. It's
Oh,
best if you get a new
okay.
one because
It's not gonna work because we've done so many different things.
it will, but it's easy if you can just, or you can zero out it. It's fine.
I think this is all, just double check here. All right, so we're gonna change to
2024.
2023, right? Because 2024 January
Okay.
2020. Okay, so let's just say
Okay.
that. That's a little one right there. Okay. Let me just make sure.
Yeah. Put Jake as the owner, so in order to run.
Okay.
Mhm.
All right. Let me see. So we put in there. We've done the allocations. Let's calculate. All right. So
Wow.
that
Yeah.
is the $1 million baby, right?
Just
That we,
270.
say that again?
I'm talking about the payment, just 270.
And that's for $1 million. Yes.
Yes.
Yeah. So this is 270 monthly premium. Yearly is gonna be 3,240. The 7 pay will be 31,000. Again, the performance of this or the return of premium depends on how you're funding the policy, yeah? So now let's just look at this, because to me, this is more important. So 3,240 that you are paying for this baby, right? All the way. The first year, just like we said, you can't see anything. So in 15 years, I mean, in this baby now, 18 years, they're going to college. How much money do they have in their account? 88,000. Meaning, are you going to get a financial aid? No. Right? And this is just based on the non-guarantee historic performances percentage that we have over here. Imagine that this number will perform even way better, because we have those open caps indexes, right? So meaning this is going to look way better than it is. But also imagine if you were putting a little bit money in this account, that 1,500 or whatever it is. So meaning at the time the child is going to be going to college, you're going to have enough money to fund college tuition without getting loans. Okay, how about you just say, I'm going to leave this account for my child when the child, Jane now is getting married, 30 years old. How much money is it that you have in that account that you can give Jane towards the wedding or buying down, paying the down payment for the house? 240, at 30, sorry, 267,000. And you leave that money for them to, you're gone and you leave there the will that says that at the age of 60, start giving Jane, $50,000 every month, $60,000 every month, from this money. But even if it's the whole amount, look at that. At the age of 60, Jane has 2.5 million in that account. This is why we see people retire very early, and we are wondering, how are you retiring at that age? Because their parents put this account for them, and maybe they were even maxi funding it. Okay, so hypothetically, right, let's go just and change this and say, okay, the parents say that I'm just, this is how much money they, did somebody catch how much the 7 pay was? Antuku?
No, it was 31,000 something.
31, okay, all right, let's go ahead and change
I
it.
didn't get the change either.
Okay, it doesn't matter. It doesn't matter exact, right? So here we said we're gonna do the specified the income. Okay, we're gonna do. Am I doing it correctly here annually?
You can just use it on the other side.
Yeah,
It's
I could have. Okay,
Please cancel that. Yeah. Go to target, cancel this one, and then
just go and okay.
yeah, go beside
Just change to 7 pay over here.
specify right here. Specify premium. Yep. So it's easy way here.
All right. And how much did we say it was? We're gonna just say maybe 5 years. It was 50. You said 51,000?
No, it was 31.
31.
Mm.
Okay. $1,000. And
I think the guideline is about 17,000, but the 7 pay is 31. Yeah.
okay. So we did it for 5 years over here. Okay. And your payment, just say.
Oh no, it's not gonna go through. You didn't click OK. Click on specify level right here. Specify level. Yeah, and then put the 31 here.
Oh, I should have okayed it on the bottom.
Yeah, exactly. But this also will give you.
What in the world?
Just delete the whole thing.
All right. So we said how many years?
Then do your 5.
5 years.
Okay, correct. Everything correct before I run it? Everything is correct. Okay, so this parent says, I'm just gonna pay for 5 years and I don't have to pay anymore. I'll just pay that 31,000 because you have that kind of money. You're an agent, you're making that kind of money. And you say, of course, they're not gonna allow you to put all the 31, but they're gonna break it down over the years. But let's just, when we look at it, right, because they don't want us to hit that MEC. So you have put in 94,000 in this account.
Oh.
94,000, right? For this account. You're not putting any more money for this, in this account. You're gonna let it be. The child goes to college at what time? 18 years. How much money does that child have in that account to go to college?
220.
Exactly. How about when the child is 30 years old and the child is getting married and mommy and daddy wants to, pay for the wedding? 150, have a fabulous wedding. Can you afford 150 for a child to go, to have a good, beautiful wedding? Yes, because they have 532. And you only put how much money? You sacrifice that 31,000 and broke it down in 5 years. And this is how much money you've put in there, right?
Less than 100.
Say that again?
Less than 100,000.
Yes, exactly. But look how much this is. How about if you just let that child, at 50 years of age and say, now you can take your money out. This is a gift from your parents, what they did for you. Generational wealth, guys. 2.3 million. How many people in our community have this? Now we have the power because we have these accounts. Let's use them the way we are supposed to use them because we are agents. We know we do better, and then we can also teach our community. This is going to get you out of poverty. So don't be just comfortable paying that monthly. That's why if you're an agent, you really have to work hard while you can and maxi fund these accounts for a number of years. After that, stop. Guess what's going to happen? The digits are going to magically grow like you would not believe. That is that power of compound interest. See what I'm saying?
I have a question.
Child becomes a millionaire at the age of what? 39.
Can I add something also on this $1 million baby?
Yes.
So for those who have questions, what if I don't have 31,000 to do this and I would like to make my child a millionaire at some point, right? This is a great example for because some agents or some parents don't have $1 million policy on themselves. So they may not, let's say if you are one of those, or the clients cannot even apply for 1 million as a death benefit for the child. What is the alternative? What else can they, as a parent, can do if your child is not qualified for 1 million? This is another way you can run. You can just say the child is allowed for 200,000, right? Either I have a policy or I don't have a policy. We agree on that? Now, we're going to look, what is the target premium? What is the 7 pay for this child, right? As usual. Sorry. What is the target premium, even monthly, right? It's so low. This policy of 200,000 for your child, just this is also for education purpose, right? In case the child cannot qualify for $1 million policy, you see, this is a $648
annually,
right, per year, which is $54
$4 monthly,
right? It's less than 2 pizzas, right? So 50, and the 7 pay 6,000, right? So now I want to show you this. Even with this account, at some point, oh, there's still income in there. For some reason, there's still income in there. But even at some point, this child at age 75, they will be a millionaire. 73, they will be a millionaire. You see that? With only 54 monthly, which they're gonna take over at some point when they go to college, right? They can be able to get a job and pay 54 themselves. So you don't have to be the one paying this.
Yes, sure.
But this also is creating a millionaire in your family with little as a cheeseburger. Okay? Just keep that in mind. Now, you can see how this policy performed. But how about now you want to be aggressive on the small policy, like Patricia said, and then you put in 3,000, right? Why is still on income stream for some reason? Now you put in 6,000. So they go to college at age 18, right? So now if you say, I'm going to be putting 5,000, right? Why? Until they go to college, right? 5,000 every year. Well, 5,000 is a lot. Let me do 3,000. Okay, 3,000. Again, this is a game of numbers. For the next 18 years, if you are putting 3,000 on the side for your child, not the 31. The 31 is great for a few years, and then you're done with it. But what about that parent who cannot afford that? What other option? 3,000 until they go to college. So same, they go to college with no loan, right? And they were, as Patricia said, they have that 200,000 as well for their wedding, right, Patricia? And he only did what? For this, only for 3,000, which is 200 something. And then at age 65, 52, they are also millionaire. See how you can create a millionaire baby any point. Either you're paying a cheeseburger, either you're being aggressive with 31,000, or either you are doing what? You are putting 300 every month, right? Still, you make a millionaire as a baby. So that's it.
So guys,
I have a question.
Yes.
Please. The premium never changed even when the baby turned 18 years old?
The premium never changes.
No.
Wow.
When you lock it at some age, you only change it if you want, but it doesn't change itself. If you had 54 as your thing, as your monthly, it stays 54 forever, unless you increase.
Right.
Great.
Yeah. So guys, this is how you create generational wealth using this powerful tool right? The 7702 account. It's not a secret account anymore. It has come to the surface. It's right in our hands. How are we applying this to? How are we using it? Are we leveraging that compound interest? It's there. Why would you want to just pay monthly when you can put a little bit more and give power to that account to grow magnificently? Right? This is why we come and learn about this. To me, this is an amazing tool that we all have to take advantage of. And I just want to say thank you for everybody who is, every day plugging in to learn, because every day we learn something. Even though you've attended this illustration training 5 times, 6 times, it's like every day somebody opens up like something that is new to everyone every day, right? And I hope that this really was meaningful and you guys learned a lot from what we shared today. Again, this, like we were saying, this is something that we've implemented every week for all of us. We all come here together to learn together, to grow together, to win together, right? So we'll come to an end of today's training. I hope that now you can design a better illustration for your clients, for your family and everything. Next Tuesday. So tomorrow is Wednesday. Well, today is Wednesday.
Thursday.
Tomorrow is Thursday. Thursday we have a class which is gonna be run by Dios. It's gonna be, I think, at 9 p.m. tomorrow. And so is Friday. So every day we are trying to do something for you guys, so that you can become proficient with this, so that you can also help the ones that you're bringing into the team. And one day I don't have to be the one teaching this, maybe Jest is going to be like the one teaching. Maybe Antuku is going to say, okay, I'll take over. I learned a lot from, your training. I think I feel confident to do that. That's what we're trying to do. It's not just for all of us, for us, me, Gigi, and Dios to be teaching. No, we are teaching you guys so that you also can now, we're going to have to carry, pass on the baton, right? And that's how it goes. Everybody gets trained as we go on, and everybody, gets great at it. And then that's how we win. But anyway, again, I just want to say thank you so much, for tuning in. Thank you for listening, to me. And I hope that it made a lot of sense and we all learned something. Have a great day, guys. Be productive. Get out there, talk to people, educate people, have your goals every morning when you wake up. What is my schedule today? What am I doing today? What am I doing different from what I did last week? Right? All right. Anybody else has to say something other than that? I think we are going to have to adjourn the meeting. Nobody. Everybody's waving. Okay, well, great. Wonderful, guys.
Thank you.
Take care.
Thank you.
Welcome.
Thank you, Patricia. It was a great training.
Wonderful.
Bye, everybody. See you tomorrow.
Bye.
Bye.